Hello everyone. Yeah. I was scrolling through reels the other day and a lady just popped by and just said, just because you do not give up does not mean you will be successful. I was so hurt. Like, just think about this. The massive young population of India has been building startups like anything, and a simple Google search will tell you that 90% of Indian startups fail within just 5 years. Namaste Nashik, my name is Aditya Rathod, and today we will be talking about startup failures in India, financial red flags, and key lessons. So sit tight because this is not only going to tell you how the startups are failing, but also will tell you how to analyze them to prevent them from failing. As it is said in Bhagavad Gita, Pratyavayona Vidyate. There are no bad outcomes because there are enough learnings. So, to start with the 90% failure rate, those claims were made 8 years before when Startup India initiative was just 1.5-year-old baby. So that context may not be truly portraying the current situation of startups in India. But, I do have some reliable statistics to offer you the correct understanding of current situation of the startups in India. Firstly, we have Bain reporting, which says that growth or venture capitalist funding increased to $38.5 billion in 2021, which then reduced to $9.6 billion within just 2 years, and again stabilized at $13.7 billion. Then we have official government snapshot wherein over 197,000 startups were registered by DPIIT, and out of them 6,300 of them were closed or dissolved as per MCA records. That's only 3.2%. But these DPIIT records does not include the startups which are not recognized by DPIIT, and also the ones which are inoperative and not formally struck off. Then again we have the common factor in all startup failures, the layoffs. INC 42 reports more than 37,000 layoffs by 130 startups since 2022. Layoffs are a classic example of how runway extension is done. Now, what is runway extension? Hang on for a moment, we will come to that. But what these numbers effectively tell us is that now startups are required to achieve milestone with lesser capital and tighter scrutiny. अभी आपको एक सवाल हो रहा होगा, ये सब नंबर्स देखने के बाद आखिर एक स्टार्टअप फेल होता कैसे है? होता है कि नहीं होता है? Right? So let us understand the next segment, the startup failure chain reaction. It all begins with unit economics. Unit economics is basically how much each unit of sale is covering the cost. Say for example, I have something which I borrowed from the hotel I live in. There is a tea bag, right? So if this tea bag, you make it for 10 rupees. Okay, now you are selling it for 6 rupees. Now for every sale, you are burning 4 rupees. Am I correct? Yes. Am I correct? Yes. Now, this is poor unit economics because on every sale you are burning 4 rupees. In this situation, more growth will conclude to more losses. Now, but still you keep producing this tea bag, so your burn rises. You want scale, but your burn rises. While the burn rises, runway shrinks. Runway shrinks meaning what? The runway is the life of the business that you are remaining with. While you are burning the cash, one day you will reach at a point that you have no fund to fund your own operations. Now these burn directly hits the current assets of the financial statements, reducing your working capital. Now as the working capital decreases, audit and governance becomes a huge burden and eventually results into distress. Then, how do we analyze those leakages? These are the leakages that we are supposed to find before they become reality. So how do we find those leakages? These are the 4 board-ready metrics I have prepared. And in fact, these are global standards, so you can use them anywhere across the world. Say for example, your total cash outflow is $500 in a month, and you are collecting against that $1.5 lakh. So your collection against the $5 lakh burn is 1.5 lakhs. Now 5 lakh minus 1.5 lakh, that is 3.5 lakhs of net burn every month. Then you have the runway. Simple, if your current bank balance is $35 lakh and your net burn is 3.5 lakhs, you are good to go for 10 months, 35 lakh divided by 3.5 lakhs. And that guy on the corner is a bonus metric for subscription-based startups, which is AI and software, the booming technology. That is burn multiple. Say for example, by net burn of $3.5 lakh, your monthly subscription-based revenue increased by $7 lakh. Okay, so $7 lakh divided by $3.5 lakh of net burn. So your every dollar of net burn is bringing you $2 of new subscription money. Highly unlikely scenario. Healthy burn multiple is 1.5x, but this is how burn multiple works. Now let us understand how advanced unit economics is analyzed. At larger scales, what companies do is they layer the contribution margins into CM1, CM2, CM3. Say for example, at order level, a company may have revenue minus cost of goods sold minus delivery minus packaging. And then at customer level, it may further reduce the payment processing charges, the refund charges, as well as the advertisement spends. And after all that, the CM3 final contribution margin should be positive. If it is negative, then it's more growth, more loss situation. And on the other hand, I have cohort analysis. Cohort is basically a set of customers. M0 cohort is basically the order value of customers is about 1,000 rupees. Then you have 1,000 to 5,000 order value of customers in M1, then M2 to 10,000 rupees. Likewise, you can create cohorts for seasonal buyers, for kinds of purchasers, for time of purchaser, for ages of purchasers, like that. And now you align those cohorts and measure the customer acquisition cost on each cohort, how much retention is being exercised, how well they are bringing back. And then you understand the payback of each cohort. Basically, how each cohort is reacting to our strategies, how well it is being recovering our cost. Say for example, in M3, payback point is month 3. In M6, you may recover all your investments by month 1. Now, when you analyze the CM1, CM2, CM3 with your cohort analysis, you can actually get the exact layer of CM and the exact cohort which is creating the leakage and work upon that. Finally, then we have the financial red flags. The depth of unit economics can go as deep as well, but we have some surface level financial red flags as well. And each financial red flag is another 10-minute topic presentation, but let me just quickly glance through it. First is CM not improving with contribution margin, not improving with scale. Basically, your production or operation needs efficiency. Then you have bond rising without unit improvement. You've already covered that. More growth, more loss. Then you have CAC payback stretching, customer aggressive advertisements, but no attraction of customers. Tata Docomo, Telenor, Tata Nano, classic examples. Then you have PNL grows but stress. Your PNL is shouting that I have so much of revenue, but cash is not coming in. What's the point? Then you have GMV is not equal to revenue. So to give you an example, a platform may be selling $1 lakh, 1 lakh rupees of goods, but you are earning 15% commission of that. So Ind-AS 115 says that your revenue should be 15,000 rupees, that is your 15% commission, and not your gross merchandise value, which is 1 lakh rupees, right? Then you go ahead with the capitalization game, our favorite auditor games, which is capitalization of expenses, biggest red flag. Then you go with close or audit delays. If you delay the audit, investors will delay the funding. If you go further, control override. If you cannot control your own startup, how will you control the investors' demand? See, these are the 8 red flags that you would want to watch on the right phase. If you go further, I have some of the key analysis or case legs of India which face some of the red flags that I presented earlier. We have Byju's. Deloitte resigned as an auditor, citing the financial statement delays, and then going further. BDO 1 year after resigned again, and it had to face insolvency proceedings. A company with a whopping $22 billion valuation facing insolvency proceedings. That's a failure. Then you go with the Go mechanic, wherein the founders themselves admitted that the financial statements have been misrepresented. Furthermore, investigations were carried out, layoffs were followed, and then at 15 to 20% of peak valuation, the Go mechanic business entirely was sold. Finally, we have the Dunzo, wherein a $775 million investment was made by $775 million valuation worth of investment was made by Reliance, but Dunzo focused on burning the cash more and more to gain the scale, but it did not achieve the scale. Salaries were delayed, and again the layoffs were followed. Finally, Reliance pulled the plug. FY25 result, all the 25% of Reliance was written off from the balance sheet of Dunzo. And finally, the valuation of Dunzo is lesser than 5% of its peak valuation. See, these are the red flags we always look for. But as a CA, we are the ones who know all of this. A cash unit and control aspect wherein you can run all the dashboards at once, and the moment they turn red, you enhance the reconciliation, contract the checks, build the cohorts, and analyze the cash. And finally, you have to memorize only 3 primary metrics: contribution margin, how runway is performing, and cash conversion. Cash is cash. So to end and conclude my presentation, I'll again recite the Bhagavad Gita shlok, Uddare Datmanatmanam. You can be your own savior. Thank you so much.